Have you ever wondered how banks keep their track of their financial activities? Today, we will talk about bank financial documentation. This topic is very important because it shows how banks manage their money and share their financial information transparently. So, let's get started. Bank financial documentation refers to the formal financial reports and records that banks create. These documents show how well a bank is performing, what its resources it has, and how it operates daily. Think of it like a report card for the bank. Just like students have report cards to show their progress, banks use financial documentation to show their financial health to customers, investors, and regulators. There are 5 key types of financial documentation that banks prepare. Financial statements. The first is balance sheet. This is like a photo of the bank's financial condition at a specific time. It shows what the bank owns or like assets, what it owes or liabilities, and its net worth or equity. The second is income statement, also called a profit and loss statement. It shows that bank's income and expenses over a certain period, helping people see if the bank made a profit or loss. Cash flow statement. This shows how money moves in and moves out of the bank, including operations, investments, and financing. It helps check if the bank has enough cash to run smoothly or not. These statements are like tools to measure the bank's financial success. For example, a balance sheet can tell you how much the bank owns versus how much it owes. Bank statements. A bank statement lists all the transactions for an account during a certain period. It includes the details like deposits, withdrawals, and transfers. This is like a detailed diary of your bank account activities. It is useful for tracking spending and checking for any errors in your transactions. Loan documentation. These documents include loan applications, approval letters, and terms of the loan. They explain the agreement between the bank and the borrower or the customer. Imagine you take out a loan to buy a house, for example. Loan documents would explain how much you need to pay back each month and for how many years. Tax documentations. These are records needed for filing taxes like income reports and deductions. These documents make sure the bank follows tax rules and pays the correct amount to the government. Accounting records. These include records of all the bank's financial activities, such as invoices and receipts. Accounting records are like a detailed notebook that tracks all the money coming in and going out of the bank. Why is financial documentation important? Tracking performance. It helps banks see how well they are doing over time, like a progress report. Supporting decisions. This document provides a reliable data to help managers and investors make smart decisions. Building trust. When banks share accurate financial information, it builds trust with customers, regulators, and business partners. Featuring planning. These records help banks plan their budgets, set goals, and identify areas to improve. For example, if a bank wants to open a new branch, it will use its financial documents to decide if it has enough money and resources to do so. That's a simple explanation of bank financial documentation. These documents are like the foundation of the bank's operations. They help everyone understand how the bank manages its money and grow its business. Thank you for watching, and I hope this was helpful. See you in the next video. Bye-bye!